Welcome to the Real Estate Power Play Podcast, your launch pad for skyrocketing success in real estate investing. I'm your host, Gabe Rodarti, alongside Mark Monroe. We're ready to bring you transformative stories, groundbreaking strategies, and the insider secrets of real estate giants. Get ready to accelerate your investment journey and become a true power player in the world of real estate.
Hello, welcome to another episode of Real Estate Power Play. My name is Mark Monroe. I'm the host for this week. If you like what you hear, follow us on one of your favorite podcast platforms or on YouTube. But this week, I'm excited. We got Mike. Mike, finally, I know we've been communicating for the last couple of years back and forth through social media. I see you out there doing quite a few deals, and it's great. I know we chatted through some Messenger, but this is the first time we actually started talking on the phone or face to face. So how you doing, man?
I know it's been wild, man. It's been a few years, but everything's been great. I really appreciate you having me on today. I'm excited to talk some shop and have a good time. But
now you're mentioning before we started before we hit record, you're up in the Pennsylvania area.
yep,
Are you in Allentown or just outside of it, or like what's the town called?
we're just outside of Allentown in a community called Lake Winona. So it's like a little HOA community. We actually bought this house sub 2, which is pretty cool.
Nice.
Yeah, so it's about, I would say if anybody's familiar with the Northeast, we're about an hour and 20 from Manhattan.
Okay. Nice. Yep. And what, about 45 minutes to an hour to Philly?
Yep. So we're dead slap in the middle of all the big cities, which is cool.
Nice. Nice. Now how far are you from that one road? I'm from New England and I'm down in Florida and I hate taking 95. First of all, I don't want to drive, but I have a gentleman, he's like a mentor towards me. He's like 74. He lives up in Cape Cod and he was a mentor in the stock market. I've known him for like 25 years and he made all his money. He had a medical billing business. He had all the billing for all the Boston hospitals, Philly. So he did really well. And so couple of years ago, I was helping him drive down his vehicle, and we ended up going. Was it 84? Is that the main road out
Oh
that way?
yeah, 84. So it cuts down and across, and then you shoot. That is the worst.
Which
It's
is that worse than 95? Which one's worse, taking 95 through the cities or 84 going around like Baltimore, DC, Philly? Well, and what's worse?
I would say honestly, 84 is way worse because you got to cut through all the
Trucks.
major cities to try. Yeah, it's crazy. So
But
because I was
once you
actually,
got through it, it was actually beautiful when I got south. You know what I mean? The mountains and
yep,
going through is it Shenandoah Mountains that goes through down in there?
yep, in Virginia, and you come down through. It's just right around like the New Jersey, PA, DC area. If you get through that, you're golden.
It's all trucks, and I guess that's where all the trains. I guess that's the main. And I see all these huge warehouses for all the big companies all through there. So, anyways, so Mike, tell us a little bit about yourself. Tell the viewers and listeners, a little bit about yourself, your full name, and give yourself a little intro to yourself.
Yeah, absolutely. So my name is Mike Scarpa. I'm originally from North Jersey, so in a little town called Bayonne, right outside of Staten Island. And I grew up there. I went to college in Philadelphia, and that's where I met my fiance, Jay. And I became an accountant out of college. I did my corporate thing for not very long. I think we graduated college in 2018. I was an accountant for 3 years for a venture capital firm. And they were doing, a lot of funds for like different syndications and things of that nature for commercial buildings. And then I realized I don't want to sit behind a desk anymore. And COVID happened, got the opportunity to work from home and started buying a couple rentals in Philly, rehabbed them, got through that, and then ran out of money, hit our limit on our debt to income. And we said, now what are we going to do? And me and Jay always kind of starting everything from the bottom ourselves. We were like, we have to figure out a way around this. What are we going to do? How can we get around a bank in terms of not needing their money? And then how can we get money so we don't need to use our own? And we wind up stumbling across creative financing, actually by accident, because we went to a virtual meetup. A couple people were talking about it, and we were like, hey, can we pay you for your time? What are you talking about? And got to learn from there. And that was in, I would say, February of 21. By May of 21, we were already starting to talk with leads and get everything rocking. And we wind up buying 3 houses that year
Awesome.
on creative financing. So
Congratulations, man. Love it.
thank you, man.
Love it.
Thank
Are
you.
they all subject twos?
All of the ones that we've bought were subject twos, yeah. Or we do them up here on mirror wraps. At least that's how we do them with our attorney. So we've been
Nice.
buying all of our properties on mirror wraps.
Nice. I know I see all these guys in the groups doing assignments. I'm thinking to myself, what are you guys doing? Are you guys crazy? You're
Yeah.
leaving so much money on the table. You know,
Yep.
they're doing like trying to get an assignment fee, $10,000, $20,000. Sometimes they're trying to get more. But if you stay in the deal, you can make that money in the front end, cash flow, and make another make another 50 to 150, $200,000 in the back end. I mean, that's a $200,000 plus swing on some of these deals if you hold it and you structure it the right way. I'm just like I scratch my head sometimes.
Yep, that's speaking of which is actually what we do. So any single family outside of Philadelphia, Philly, I would never do this in. We do actually Section 8 in Philadelphia, but outside of Philly, we do rent to own. So we buy it creatively and then we'll sell it on a lease option. We haven't had a buyout yet, but we have potentially one that's going to be buying us out before the end of the year, and that is a 6-figure deal, and we bought it 2 years ago. So
Awesome, man. I like it. And what do you normally do like on that? Because I know what I do, but when you're taking it down subject to the seller, are you doing like a 5-year, 7-year, 10-year balloon with a seller?
in terms of like, if it's just they have no equity in the deal, we're buying them
Yeah,
out
because
up
at
front,
some
right?
point they want to, yeah, at some point they want to get out of it. They want their name off. So what's your typical structure on something like that?
Yeah, actually, so in our mirror apps, we state that we're just taking, if it's just straight, like they're out of the deal completely from day one, it says that we're taking over their loan for the remainder of the term, but there's no prepayment penalty. The only way that we typically ever have a balloon is if we owe the seller equity. So like a hybrid wraparound mortgage. Um,
Yep.
and we're
Nice.
typically doing, we personally, me and Jay, we haven't bought anything with less than a 5-year term because we know that if we put a rent to own tenant in there, we can say that they'll buy us out in 2 years, but we know that that's probably not the case. So,
No, it's usually what I've always noticed is anywhere between 18 to 30 months for them to kind of get their situation cleaned up. And they need to make sure they have a little bit of, reserves because they have to still do the closing costs too. But, at the end of it, you can structure it ways in your contract that helps them out towards closing costs
yep.
on that as well. So yeah. So is that your typical term is 2 to 3 years with your rent to own buyers?
Yeah, so right now, all of our rent to own buyers, we have them on a 3-year term. We only have one on a 2-year, but that's because their credit was actually like pretty good by the time they got there or got to us. So on the 3-year terms, and at the end of the 3 years, we have somebody coming up on that, and we expressed them. We said, "Hey, look, your term is coming up. You've been great. You've treated the house amazing. You're probably one of our best tenants. I'm not going to ask you to leave, but I am going to adjust the price, right? And I am going to readjust things. Don't need to give me another down payment. And, maybe we can extend it at a yearly basis now at this point."
Yeah,
So,
smart move. Yeah, and one thing about in the creative real estate investing world that you need to make sure you guys do the right things because it can be very easy where as an investor where you have these opportunities where you could take advantage of your end buyer and you don't want to do that. You want to do the right thing. I had an example. I had one just now in Alabama that came up July 1st. Same thing as a 3-year term. He was not ready yet. He couldn't qualify yet because I guess his wife got injured, so she took some time off, and he put $20,000 down on an option fee, which is non-refundable. We sold it to him for 203. I sold it to him for 203. The current value on it right now is 235. Technically, by contract, I'd say, hey, you know what? Sorry, you're done. That's non-refundable. You're supposed to, and I could turn on sold. That's a $40,000 swing. But what we did is, we said, you know what, the market rents jumped up. We're going to increase your payment by $150. And what we'll do is I need an extra $5,000 option fee down. That's non-refundable. And we just adjust the price to 208. So you guys want to do, if you're listening and you want to know more about this seller financing stuff, you want to make sure you're doing the right thing. You want to be able to put your head down on a pillow because, there is, I call them scumbags out there that will take advantage of it. And I remember years ago, people used to do that. I mean, what's happening now, I remember in 2003, actually a couple of times. I remember before 9/11, and I remember like around 2003 to 2004 and 5 before the market took off, people were doing like these crazy down payments to the end buyers, not even making sure they qualify, taking a 20, 30, 40, $50,000, knowing they couldn't qualify, they default, kick them out of the property and keep the money and do it over. Guys went to jail for that stuff, and they deserve to.
Yep, absolutely. Like the way that we look at it, we've had people ask us, oh, why don't you just get a new tenant buyer? I said, well, let's do it in 3 different ways. One, this is a livelihood. This probably, or maybe the down payment they gave us was their savings account. We presented them an opportunity to help them, not hurt them. We're only setting them back however many years now if we do that. 2, why do I want to take my house back? Have my team go through all the marketing again, figure out a tenant buyer. What if they leave and they're pissed off and they destroy the place on the way out? Right? All these different things can come. The family's happy, they love the house and they express they want it. We have the resources to allow them to stay. Can we come to a middle ground and like just, ethically be good humans about it, right? Like that's why we do this,
Absolutely. And that's why I was talking earlier. You got to make sure you guys do the right thing. If you don't, we're going to come and hunt you down because we want to make sure you guys. The beauty of creative financing is you're helping the seller out, you're helping the end tenant buyer out, where they can become homeowners, and you as the investor can make a little bit of money along the way. So you want to make sure you guys are doing the right thing. So Mike, let's talk, like, how do you find your deals? How are you kind of out there sourcing, what's your strategy and what's your team? How do you guys handle that?
Yeah, absolutely. So we actually started for the first year of us doing this. So we started everything in 21, like I said. The first year we did this, we entirely did everything organically on Facebook. So from going live, putting posts in groups, telling everybody what we do, have a strong business page on Facebook. Literally, that's how we were getting all of our leads. And we were finding sellers that really needed our help. After a certain period of time, we were like, okay, this isn't super scalable. So what are we going to do next? And we wind up transferring that to Facebook ads. So our entire business is off of referrals right now and Facebook ads, sponsored ads. And
that's awesome.
Yeah. And Facebook and social media have been the platform for, I think I could track back every house we've ever bought. Even if we bought it on the market, it was still referrals saying somebody, hey, this is a really good house. I think you should check it out. And then on top of that, we also have pretty much all of our leads. They flow through the CRM that we have, and our VAs, they collect the data. We have a script that they run. And everybody always like is mind blown, but I tell everybody, and this is what we do, our VAs, when the lead comes in, we don't hop on a call with them. We actually text the seller back and forth for like our discovery questions. And we've noticed that our response rate is actually a lot higher because people can communicate with you throughout the day or throughout whatever they're doing. And then once they're qualified, I either hop on the call with the seller and I'll close it out and negotiate it. And sometimes we've even just done that over text message as well. But that's kind of like our little process right now. We've been doing like 3 to 5 contracts a month. We wholesale some, we'll buy some and relist them, and then we keep the ones that are in the areas that we really know are good for rent to own. So
Sounds awesome. No, I like it. I think that's a great idea with the text messaging with the VAs. Because sometimes when they get on the phone and they start talking, the seller starts talking, they kind of get turned off sometimes, the language barrier.
Yep.
So I like that.
Our main market is Pennsylvania, and in central PA, it's very blue collar. So our VAs are from overseas and I love them to death, but the sellers, we were giving us so much kickback. That's why we actually had to transfer to text. And since then we've it's been like butter.
Yep.
So it's exactly right.
I think that's smart. I actually had my VA actually jump on the phone call with the seller at the end to see the motivation. But I think you're right. You can figure a lot of that out through the text messaging. And then at that point, I do the same system, but my VA will actually run my comps, do a deal analysis, and make sure it all meets. And then at that time, they just will schedule a call with me and the seller, and then just put it right on my calendar link, and then boom, it just pops up. Go to my CRM, read the notes, and just go through the process.
Literally identical. We have a girl who runs the script. Then we have a VA who do like rentometer comps. What is it near? Is it near Walmarts? Is it near shopping centers? All that stuff. And then we just keep it super simple. We have Calendly, and they just put the information in Calendly, and then I get the notification. So it's same process.
Yeah, it's great. It's a good. You have to have systems in place. Now, how do you guys? So are you doing when you're running your marketing? You doing the whole entire state of Pennsylvania, or are you just doing by zip code? Or
Yeah, so when we tried a couple different things, and what we've figured out works the best with Facebook ads is being really broad. So we started off by we want to specifically buy here, here, and here, and we want to target people who with these keywords. Our cost per lead was through the roof, and meaning, just for people who are listening, that basically means for every lead that comes through and for every dollar you spend, if you're spending $100 a day and you only get one lead, it costs you $100. So when we went broad, we opened it up to the whole state, and we got rid of all keywords. Where now for the same amount of spend, quadrupled our amount of lead flow and cut our cost per lead down to like a fraction.
that's awesome. So how do you guys look at, because you're getting everywhere in Pennsylvania? What's your approach when you're looking at a property that's out in a rural area?
Absolutely. So that's actually a really good question, and I love that one. So what we've told our VAs and what we look for too is when we're looking at a rural area in Pennsylvania, which is, I would say, a very large portion of central PA, we're looking to see, okay, if it is rural, how close is it to a local Walmart? How close is it to a shopping center? Like big corporate stores, are they within at least a 20-minute drive? If they are, let's look into the deal more. If it's not near a dang thing, you can't short-term rent it because there's no camping sites or things like that. We typically will tell the seller, hey, unfortunately, I don't want to waste your time. I don't think I'm the right person for you, or we're the right team. I think the best bet is for you to find somebody local, and try and go with them. So.
And why, just so the listeners can understand, why don't you want to go down that rabbit hole on that particular deal when you have a seller that's motivated?
Absolutely. I'll give you like a firsthand example. We had a house that we actually bought, and it was no money down, no interest, no payments for 6 months. I think we got it for like 30 cents on the dollar.
You can see where this is going.
Yep. And we were like, oh man, this is a killer. We're the best. I'm the man, right? I was like, blah, blah, blah. And you look at a map and you're like, okay, well, where's the closest even Dollar General? And it's an hour away. So we were like, we'll sell it. Maybe we'll just resell it on seller financing or find a handyman special. Yeah, that didn't work. We sat on it for like 8 months, and not a person really even reached out. And the people who did pretty much went and said, oh, like, can I give you $20 a month or $100 a month? And so we wind up basically just selling it for a loss and walking away. But
that's why I wanted to ask that question, because people people coming into this and they're like, oh, I can get a deal. Like you're saying, you're going down that rabbit hole. All of us been through it, and you get into doing creative seller financing strategies. We all go down that rabbit hole. And I'm going to give you another example of a rabbit hole. And I'm sure you've been through this, Mike. I'm going to ask you your situation. I'm assuming you look at the median price range of the area when a lead comes in. Okay. Let's say, for example, if it's a medium price range area and it's 250,000, but you have a hot lead coming in, the seller's motivated, but he wants 475 for that property. What do you do with that?
And personally, it depends on the terms. So like if that lead comes through and they're like 475, I personally never even If they're open to terms, I won't even look at the price. I'm like, cool. Is it free and clear? Can we do straight seller financing? Even better. Can I get the payments low enough where I can still cash flow in that market and I have a long enough term where I'm paying it down quick and I can build in my own appreciation and my own debt pay down. So that's what we would do with that lead. And if we can make the terms work 100%, if it's a cash deal, I'm out.
Yeah, the other problem that I've noticed, it's changed a little bit, but do you look at the Airbnb on some of those, like in the higher end homes?
We do. We've noticed here in Pennsylvania that anything over 350,000 doesn't cash flow long term or even midterm. And a lot of the higher end markets have now regulated short term. So then we're kind of, at least here in the PA markets, we're pretty much just crap out of luck. We have helped a couple sellers where if that's the case, we'll tell them, hey, look, if you were willing to do terms with us, I really wouldn't be able to be the buyer. But at the end of the day, I think I can help you find somebody who will rent it and then buy it from you in the future, like a homestead buyer.
Yep. Smart. Yep. Yeah, that's smart. What I've noticed over the years, a lot of times, if it's I like my buy box, I like whatever the median price range is. I like to say 20% above it and 20% below. Because typically, like if I find a property that's in 250 range and I get up to 500, 600, 700, it's hard to find an end buyer to put in that property to make the numbers work. And you hit the nail on the head, is really, can you make the numbers work? How often, what's the percentage of the time that you really can make those numbers work?
Based on just the amount of deals that we keep, right? Or the deals that we write up, we have about 50 inbound leads per week that come in. Out of those 50 leads, we're typically putting a contract on 1 to 2.
That's
So,
good. Those are good
um,
numbers.
and on average, out of the 4 deals that we're on it, we're doing about 4 deals a month right now. We typically keep about 1, and then the other 3 we either are going to assign or buy and then resell.
Yep, I like that. So what's your team look like? Like how are
Absolutely.
you set up to do that? If you're doing, 50 leads a week, you're getting some contracts, you're doing about 4 deals a month, you're saying 3 or 4. So what's your team look like?
Yeah. So right now I am the closer. That's one role that we're really trying to remove me from, but I do
Good
enjoy
luck.
it. Yeah, it's hard. We've tried many
It's so
times.
hard.
So I'm the closer right now. Jay runs all the operations, so creates all the standard operating procedures, does all the hiring, firing, reviews, the whole nine, um, all the tech stuff. And then we have 2 VAs that work for us full time. So we have 7 days a week coverage, 12 hours a day. We have one of our VAs will do the discovery questions, and her job is to just talk with the leads, get all the questions answered. And then we have another VA where she has 2 roles. She helps us with basically like our lead manager. She does all the deal analyzation before it comes to me. And then she also does all of our content for social media. Um, and then we have a transaction coordinator and then a dispo manager that helps us either find the end buyers. So
Got it. So no, that's a great strategy. So do you have an in-house transactional coordinator, or is it an outside third party that you use?
yeah, so we for the longest time, I think it was like for about a year and a half, we had an in-house TC. Loved her to death. She just decided to go a different route. We tried to have a couple different in-house TCs and it didn't work out. So we wind up finding a third-party company, and we've been with them for like I would say like 8 months now, and
Okay.
they've been handling our capacity pretty well. Um,
And you're closing roughly about 3 deals a month, you're saying, roughly, give or take?
yeah,
3 to 4?
yep, yep.
Okay.
So
So that's great money. Like that's really like that's where a lot of people young, oh, I want to blow it up. I want to have a whole big team and I want to, but if you look at your situation, right, and you're putting these into your pipeline, the ones that you're holding, you're cash flowing, You make money on the front end, you're cash flowing, right? And then you have like the way I look at it, I anticipate like about you're going to get to a point where you're going to probably have about 4 or 5 years that's going to cash you out. So if they cash you out and your spread on that back end's 50,000 to $200,000, that's great money, man.
Yeah. And
You know,
no more flipping. And we're just buying properties, letting them pay, rolling it.
I can't tell you. Last night we're analyzing a deal with one of my members, and we're going through it, and it was a 10-year term, and he was going to over the 10 years, he was going to make $267,000 on that. And I'm like, you just keep building it, you keep adding them to your pipeline, keep adding them in. They're going to eventually at some point, those are going to start cashing out, and all that capital is going to start coming in. Then you got to figure out what you're going to do with your taxes.
Yeah.
That's another whole game.
Then it's a different problem.
Nice. Have you started playing around a little bit in the commercial, or you just strictly staying to the residential world at the moment?
So we would love to. We dabbled in it a little bit at the beginning of this year. We were doing some direct to seller marketing on some bigger multis, like 20 plus. And what happened was I started getting a little distracted away from the bread and butter right now. So we pulled back on it. But eventually our goal is to get some storage units, like small mom and pop, target them locally around here. There's a ton, and get some of that, and then focus anything with tenants, have them focus on rent to owns or residential multis. And then anything commercial, we'd like to have like just more of like a business like type interaction.
It's hard. It's funny is Ryan, Ryan is always there. You and Ryan are always,
Yep.
we see you guys posting like crazy all your deals in the seller financing group. But he did the same thing early in the year. He tried doing the same thing in the multifamily world, doing the same thing. You're learning all over again in a sense where this is your bread and butter. So and it's hard because you're trying to this is the animal that's feeding you, but then you want to always want to try something different to try to get into commercial. That's everybody's like, but a lot of times you can just stay at the residential and be comfortable, and then once you get some cash, then you can kind of do some of that stuff as well. But you're right, it's this is where you're feeding at, and then you try to bring people in to fill your shoes doing the closing, and it's a
Yeah.
challenge there.
Yeah, we went through about, I would say, 7 people that we've tried to replace me, and nothing bad, but it's just they just can never get them to be as motivated or hyped as
Yep.
me or answer the phone. It's like,
And then, yep. And then when you
so,
do find the right one, they'll only stick with you for 6 to 8 months, and then they're going to go off on their own. So it's a challenge.
yep, that's also what we found. We had somebody working for us doing an amazing job, and they're like, I really think I want to start this on my own and quit my job. I'm like, no, please.
I know it's hard.
Yeah.
That's why it's like I've over the years, like I've had many different businesses. I was mentioning I had a mortgage company with 107 loan officers. I had many different
Wow.
teams. Yeah, 107 loan officers uh, at one time, and then I had another one. We had small business lending. We had 18 there. I had back when the collapse, I had a loan modification company that we had underwriters. We had 81 employees on that one. But I'm to a point now where l- less is more. Like if I want to take off and enjoy, like I was just in Spain, I'm in South Florida and I like to travel. So we're leaving next Tuesday. We're going to Seattle. We're spending a few days there. Then we're jumping on a cruise, going up to Alaska. Then we're coming back. I think we're going to go to Vancouver, Canada, and then we're going to jump over to Lake Tahoe for about a week. So, but I love working remotely. So, I can work. I'm to a point now where I can 80% of my stuff I can do. My VAs handle it, and I can do it off my phone.
Yep.
Otherwise, I just jump on a phone call and talk to sellers or people like yourself and network. That's the beauty of it. You're still young, so you're hungry and you got that drive in you. I'm a little bit older, so now I'm to a point where I'm like, okay, I want to enjoy life, enjoy that. I don't need that. I don't need to grind it as hard anymore.
Yeah, but you put your stars on the wall, man. You've done it. So
Like I said, 107 loan officers. I was working, you know, 10:30, 11:30, 12:30. That's with the old crackberries back in the day.
That's funny. Yeah, man. I,
So
I I give you props. I don't know if we've always talked about having an office and doing this and doing that. And at one point
Don't
we
do it.
looked at each other and we said, but didn't we start this so that we can like actually enjoy ourselves a little bit? So
So that one company, we had 81 employees, and we were at a point, we had roughly about 40 employees, 45, I don't remember exactly the number. And we're like, okay, do we want to take this additional whole office space on? We're like, okay, we did it, brought all these employees on. My partner and I, our take home income did not change at all from the
wow.
40 employees to the 81 employees. The company made more money, but us, my partner and I, we didn't take any more money. It was just a lot more headaches, a lot more expenses. So what I've tend to learn over the years, sometimes less is more. And then I tend to evaluate, like, people when you're younger, you guys have goals like, I want this much money, I want $10 million, I want $20 million. Now I'm at an area my age, my goals have changed. My goals now are like, I just want to be comfortable, enjoy life, not worry about bills, and have that passive income coming in and travel and enjoy it. Does that make sense?
Yeah, absolutely. It's crazy that you said that. So I'm a part of a mastermind group where it's more so about like inner wealth and mindset and things of that nature. And one thing, including myself, a lot of the younger guys in the group and gals are always talking about, oh, I have this goal and I want to hit this. And our goals, the younger people's goals under 30 are always monetary or like shiny, like driven. And then people in their like 40s and 50s, you can see it starting to change. And what I had asked the guy, our mentor, in that mastermind about the about mindset, I was like, but what happens when I hit these goals? Like, and he's like, but what are you talking about? Like, your goals are always changing. He was like, your goals when you're 70 are not going to be your goals at 28. So it's crazy that you say that. It's yeah.
No, it is. It's just like you shift them and you just like, it's about enjoying life a little bit. So let's talk a little bit more about a couple of your, like, in your real estate journey. Like, what do you think was the most challenging thing that was like a big learning curve for you, or that may have cost you some money in a deal? Because that's where people really learn, is like by listening to people's mistakes. I've had some, I'm sure you have some. I like to kind of throw it out there because I think that's where people really learn, is by people that has been in a situation. Why don't you throw one out there if you don't mind?
Yeah, absolutely. So I'm gonna get super raw on this one because this one still hurts. But this
I've
was
had them.
this was our first creative deal. We found it on Facebook Marketplace. Um, Guy wanted like 5 grand down, and it was in a really good town in Western PA or outside of Pitt. So we said, wow, 5 grand down, great area. What we didn't look at was, how big is the house? What is that area like in that town, right? And how long is the term that the seller's given us, and what are we going to do with it? So it's a 5 bed, 4 bath, 3,000 square foot house that needed some work. And we were like, oh, we're going to sell it on a handyman special on a lease option. We're good. Don't worry about it. Right. Didn't do a thing to it. Well, close on it. And we said, well, we got a 4-year term with the seller, and his mortgage is $25,000 left on it, and we owe him 98 on the back. We'll be fine. Our tenant buyer is going to cash this out, right? No problem. And this is right around November. So February comes along. We're still searching for a tenant buyer. We finally find one. They're like, hey, I got my 20 grand down. We have 6 kids and 2 dogs, and we got the money. Let's do it. We can afford it. We looked at their pay stubs. Oh yeah, you can afford it. Fine. What we didn't take into account was that they got that money from a tax return. It wasn't technically their money. It was found cash. So thinking about it, like from a logical standpoint on our end, we're like, oh, great, just give us the cash. Here's the house. Your husband's a contractor. You'll do the work. Awesome. But we're not seeing it from the other side of, what do they have to lose? It was never their cash, right? It was just money that they were getting back. They got in the house, paid for a month, never paid again. It took us like 6 months for them to get us out, and they did 40 grand in damage, give or take. And then by the time we got them out, we renovated it. We didn't have the money to renovate it because we just started. We basically put it all on a 0% credit card, and we tried to get another tenant buyer. We couldn't find one. So we wind up selling it and breaking even in about a year and a half right before our term came up. So that was a crazy one.
First deal. And
Yeah.
I'm surprised you guys stayed in it. I can't tell you how many people that we all to be in real estate, you're gonna have some scars. You're gonna have them, but you just need to have enough wins to offset those. And that's great that you brought that up because you're a prime example that you guys stayed with it. Most people, when they get those scars, leave and go out of the industry. They're like, I can't do this, blah blah blah. They get hurt, so that's great that you did that. You know,
Yeah,
so
the way me and Jay looked at it was like we started everything from my mom's garage, and we lived with my mom for about 8 months to really help get some things rolling and cut expenses. We said, we got to keep moving. We didn't do all that for the past year to just quit on deal one. And then we bought more, and we were like, all right, look, we cut our losses. We learned, forget about it, and just let it go. So,
yep, exactly. You got to look at your failures, your learning experience, all it is. So you learn from it. That won't happen again. It's amazing. I had about a year and a half ago, I had somebody was kind of helping out with a deal, and it was a deal in Orlando, and he wanted to buy this deal so bad. And he goes, look at the Airbnb numbers. Look at the Airbnb numbers. I'm like, well, what's your long-term rental numbers? And he says, I said, those numbers are not working. You're by $800 difference. I said, those numbers. I go, I don't care. The Airbnb numbers work. It was a beautiful home. They put a lot of money, but he was overpaying. Well, you saw now what's going on with the Airbnb market out there, right?
yep.
Especially in
Yep,
Orlando. So
exactly.
he's coming out of pocket by $800 a month because he put somebody in there for 6 months, and now he's done with real estate. He's like he's not going back into it again. I'm like, I told you to make sure you have a backup. I wouldn't have done that deal. You asked my opinion, I wouldn't have done that deal. He didn't want to listen, and so that's what they learned from. So it's sad
Yep.
that they do that. You said something there a second ago, and about a handyman special on a lease option. You want to kind of talk a little bit about that because a lot of people don't understand what that is if they're listening to us, and some people may know what it is, but us investors, we look at that, and that's one of our exit strategies is a handyman special. Why don't you kind of give the viewers and listeners what that is and how you structure that?
Yeah, absolutely. So, example for a handyman special, and I'll just break down this deal just to bring it to light more. So, typically, what we'll look at is, okay, is it pretty much turnkey? Like I'd be able to put it on the market tomorrow. That's not a handyman special. Is it a full gut rehab? Not a handyman special. It's that in between where it's like old carpets, it needs paint, it's dated, but it is, you technically could put a bed in the bedroom and still live there tomorrow, right? That's a handyman special. So what we've done on a few of our deals is we'll buy them creatively on a handyman special. We'll try and get no money down with the seller because we'll explain to them, this thing needs work. And then what we'll do is instead of asking for a 10% down payment from our lease option tenant, we know that they're not going to be able to give us 10% down and then put X amount into the property. We'll say, look, this is a handyman special. We'll give you a discount on the not the entry fee, but the option deposit, right? And instead of 10%, we'll ask for 5%, but you got to come in, move in, do the work to the house, and basically make it your own. So
Nice. Nope, I like that. I've loved those type of strategies. I've even done them where I've gotten 6 to 8 months, payments with the seller on some of them. So it's
yep.
all how you negotiate it because you're helping the seller out because the house, depending on the house, I typically those are people can't move in quite yet, on something like that.
Yep. There was one where we did it where I would say it's maybe a little bit further past the handyman special. And it was a mirror wrap, but the seller said, hey, look, I can still make the payments, but I just want the responsibility off my plate. I don't want to think about it. I asked her for, I think, 4 months, and we agreed on like 90 days of no payments after closing. She kept making the payments. We cleaned it out. we did a paint job and put some carpet in, and nothing Taj Mahal, and then we put a tenant buyer in the house.
Nice,
So
nice job. Let's
yeah.
you've mentioned the word mirror wrap a few times, and let's just kind of give the listeners what that is. Want to break that down a little bit so they can understand what that means?
Yeah, absolutely. So basically, a mirror wrap, in essence, is doing the same thing a subject to deal does. You're taking over the mortgage subject to someone's existing or on their behalf, right? The only difference between a subject to deal and a mirror wrap is that with a mirror wrap, there's a new mortgage created that goes around the old debt, but it mirrors the terms of the old loan. So with a sub two deal or subject to deal, it's basically deed transfers, mortgage stays in seller's name, and sometimes there's really nothing in between for recourse for the seller, right? And then you need a loan servicing company for proof of payment, right? But with the mirror wrap, what it does is that mortgage is stating that there is a guarantee, not a guarantee, but basically there is an agreement between the seller and ourselves that we are to pay the old mortgage every month. And then there's also a note put in place outlining the terms of potentially that old debt and what were to happen. Here in Pennsylvania, we also couple a mirror wrap with a deed in lieu of foreclosure. This is like controversial because a lot of people say, oh, you do a deed in lieu and you'll get the house back next week. It doesn't, it's
Still
more
got
of
to go
like
through the court process. You still got to go through the court process. Yep.
yeah, exactly. But the reason that we do the oh my God, the mirror wraps is because of the deed in lieu. And then having the seller doesn't, well, we don't need to get a loan servicing company because the mirror wrap is now proof someone's making payments. And then it also helps the seller with their debt to income we've seen it at a much quicker pace than with using a loan servicing company. So
So you're buying it on a mirror wrap and then with them and then selling it as a lease option?
correct. Yep. Yep.
Oh,
And we bought this house on a mirror wrap. We wind up moving into it. We were gonna do a lease option, but
uh,
it's the same thing. So
and what if the seller's got $50,000 of equity? How do you structure those? Let the listeners hear about that. How do you structure that?
yeah, absolutely. We have a deal right now we're under contract on. I don't know if we're gonna keep it or if we're gonna buy it and then resell it. But basically the way we structured it is the seller owes 298 on it and they want 365. So that amount of down payment, right? We could make it a mirror wrap where we just take over their payments, give them a huge chunk of money down and let them move on. But the whole point of this creative financing and everything is to be able to get into a deal with as little as money as possible. So we said, look, for you to leave the house, how much money do you need to move on? They said like 10 grand. So we said, okay, I'll give you 10 grand. I'll pay your closing costs. What's the longest you'll give us to get you the other like 50,000 or whatnot? And they're like, what do you mean? And I explained to them, I said, look, I'll pay 360. You'll get 360 out of this house. I'll give you 10 at closing, but you need to give me some time to get you paid out for the rest, and I'll still pay all the costs. Are you able to do that? And in the meantime, I'll make the payments on your behalf. And they said, well, we're retiring in 7 years. That paycheck would be so awesome as a retirement gift. I think we could give you 7 years. So we wind up getting a 7 year term, 10 grand down, and then make a payment on a 3% mortgage for the next however long.
Awesome. And then are you wrapping that in the one mortgage or are you doing a second mortgage on that? How, why don't you talk a little bit about what that looks like?
Yep. So for those where there's seller's equity and then there's also the mortgage, we do what's called a wraparound mortgage. So basically, we throw a new mortgage around the old one, which also encompasses the seller's equity. So instead of having like a first lien and then a junior lien or a second lien with the seller's equity, it's just in one big lien, and the mortgage right is the seller. And we're to take over their payments, and that's what it says in the note. And then it says you also owe Mr. Smith 50 grand by like 2051 or whatever the date is. So
Awesome. Mike, good stuff. It's good to actually have somebody on here talking that knows our language. I could sit here and go on and on for
Yeah.
hours because it's like, you know what I mean? It's because it's another whole world that our minds, more and more people are starting to come into it, like yourself. But I enjoy sitting there talking and kind of talking shop, if you will.
Yeah,
This stuff is so much fun. And
absolutely, man.
that's just one type of creative seller financing strategy. There's so many other ones as you get into it more and more. So, Mike, how can people reach out to you?
Yeah, absolutely. I'd love to have a conversation with anybody who ever has questions or wants to chat with me. You can find me at Instagram at Roman with Mike, so ROMAN with Mike. Or actually, if you wanted to, you could just shoot me a text message. I actually on my phone a lot more often. It's 267-819-2539. And that would be the best, and we'll have a conversation.
Well, thank you all for listening to another episode of Real Estate Power Play. This one was great. My, creative seller financing or creative financing strategies, whatever you want to call it. But I love this type of stuff, and we've been doing it for years and years, and it's so I'm excited. Mike, thanks so much for coming on. I appreciate it. Thank you so much.